How can you become a successful investor? Learn the tried and true habits of successful investors, such as their investment goals, the types of investments they make, and the need to spread their money around. After finishing their education, many young people start a new job or their own business. They are, of course, very happy with their new jobs and the money they get at the end of each month. They hope that the money they make will help them reach their goals one day. They want to do well with money like Warren Buffett. Here are top 10 habits of successful investors. However, before we begin our countdown, we would greatly appreciate it if you would subscribe to our YouTube channel and also press the bell icon. Let's get started. Number 1. If you save, you succeed. When you first start making money and put it in your bank account, it makes you feel good and encourages you to buy things for yourself and your family. Make a list of your fixed and variable expenses and figure out how much you can invest each month. Make sure you save that much every month in a responsible way. Don't spend more than you have to, and put off spending money on things you don't have to. If you start investing early in your career, when your financial responsibilities are low, you can build a good portfolio over time and become a successful investor. Number 2. Pen down your goals. Most new investors want to buy a house, a car, go on a trip, buy some nice things, etc. When you know what your goals are, you can figure out when you will need money and where to invest it. For example, if you want to buy a house in 5 years, you can mix equity investments with fixed investments. You can also invest in fixed income instruments or liquid mutual funds if you want to travel in 6 months. Investing in stocks might not be a good idea here, since a sudden drop in the index can wipe out your principal. So, if you want to be a successful investor, you need to plan and write down your goals. Number 3. Don't put all your eggs in one basket. Diversifying your investments is a rule that has been around for a long time, and it's still true today. For a young investor, the portfolio should have a mix of risk investments, which grow with inflation, and fixed investments, which acts as a cushion against market fluctuations. Fixed investments like PPF, PF, NSC, fixed deposits, government bonds, etc., are less risky and protect you from big market changes. Diversify your portfolio across different sectors, such as auto, banks, IT, etc., by putting money into shares, mutual funds, index funds, or bullion under high-risk investments. When putting money into risky investments, every successful investor must follow a few golden rules. Number 4. Persistent and disciplined approach. Rome wasn't built in a day, you've probably heard. In the same way, you can build up your investment portfolio by investing regularly and being disciplined about it by putting off non-essential purchases. Young investors often spend more than they have or put off making investment decisions, leaving their money in bank accounts. This way of thinking will keep you from being a good investor. Number 5. Investment advisor VIU. Do it yourself. Investing. Investing is not a hard thing to do. To be a successful investor, you need to take the time to figure out where and when to invest, how to keep an eye on your investments, and when to get out. If you don't have time to think about your investments and manage them, you should think about hiring the right investment advisor. For example, StocksBox was made to help new investors make investments based on their investment goals and preferences without having to do much research because the app does the research for them. Whether you invest directly or follow the advice of an investment advisor, you need to do some basic research on your own. Simple research like this can help you choose the right investment and figure out when to get in and when to get out. Read the guide for people who are new to the stock market to learn how and where to start investing. Number 6. Technology to the rescue. Successful investors always find out the basics about the market and sectoral trends. The global investment landscape, the types of investment instruments, the investee companies, the advisor's reputation in the market, and so on. If you don't like doing market research or don't have enough time for it, there are many apps like StocksBox that can help you. Technology can help you choose the right investments for your goals and keep track of how they are doing in real time. Number 7. Think long term. You don't eat the fruit on the day you plant the seed. Successful investors keep their money in the market for a long time and don't keep switching it around. When you stay invested for a long time, the benefits of rights shares, bonus shares, dividends, etc. are much bigger. You shouldn't let short-term cyclical trends or ups and downs in the stock market change how you invest. Number 8. Know the market. Real estate investors who are good at what they do learn a lot about their chosen markets, such as focusing on a certain area or on residential versus commercial properties. Real estate investors can take into account current conditions and plan for the future by keeping up with current trends, such as changes in consumer spending habits, mortgage rates, and the unemployment rate, to name a few. This lets them figure out when trends might change, which could give an investor who is ready a chance to make money. Number 9. Stay educated. As with any business, it is important for a real estate investor to stay up to date on the laws, rules, terms, and trends that make up the business. Investors who fall behind risk not only losing momentum in their businesses, but also getting in trouble with the law if they don't follow the rules or break them. Successful real estate investors learn as much as they can and adjust to any changes in the law or in the economy. Also, stay up to date on real estate, tax, and lending laws and rules that could affect your business directly or indirectly. Number 10. Realistic expectations. Fixed investments give fixed returns, so you know exactly what to expect. But when it comes to other investments, like stocks and mutual funds, you should have realistic expectations about the market and the performance of the stock or mutual fund. Most of the time, successful investors decide ahead of time how much profit they want to make from their investments. Once they reach that level, they sell their investments no matter what the market is doing. Conclusion. Even though a lot of ads say that investing in real estate is an easy way to get rich, it is actually a tough business that requires knowledge, planning, and focus. Also, because business is all about people, investors will do better in the long run if they are honest and treat their co-workers and clients with respect. Short-term profits may be easy to make, but building a long-term real estate investing business takes skill, hard work, and these 10 important habits. That's it for today. We hope you found our video interesting. If you did, please give it a big thumbs up and share it with others. Also, if you haven't already, please consider subscribing to our channel. Don't forget to turn on the notification bell so you don't miss any of our new uploads. In the end, thanks for watching and see you next time.